One Up on Wall Street by Peter Lynch, a WealthWorks summary. The big idea. Peter Lynch managed the Fidelity Magellan Fund from 1977 to 1990. During that time, the fund averaged a 29% annual return, the best record of any mutual fund in history. One Up on Wall Street is Lynch's argument that the average investor has a significant advantage over the professional money manager, and that most people throw that advantage away by not using it. The advantage is simple. You see things in your daily life that Wall Street analysts do not. The companies you interact with every day can be the best investment research available. About the author. Peter Lynch is one of the most successful investors in history. He began as a caddy at a golf club where executives talked about stocks and worked his way up to running the most successful mutual fund in America. He retired at 46 to spend more time with his family. His investment philosophy has influenced generations of individual investors and professional fund managers alike. Chapter 1. The Amateur Advantage, Part 1. Lynch's central argument is provocative. The amateur investor has advantages the professional cannot match. Professional fund managers are constrained by institutional rules, peer pressure, and the need to justify every decision to committees and clients. They cannot hold positions that look bad for too long, even if they are right. They tend toward consensus, buying what everyone else is buying, because it is safer for their career to be wrong with the crowd than right alone. Your edge is your life. The amateur investor, by contrast, can act on what they actually know. Lynch's most famous example. If you notice that everyone at work is talking about a new product, that the lines at a particular restaurant never seem to shorten, or that your teenager is obsessed with a brand whose stores are always packed, you have just done better research than most Wall Street analysts. The professional is buried in spreadsheets. You are walking through the real world. Your edge is your lived experience. The action for Chapter 1. Think about the products and services you have used in the last month that impressed you. Which companies make them? Are any of them publicly traded? Start paying attention to business quality in your daily life, not as a consumer, but as a potential investor. Chapter 2. The 10-Bagger, Part 1. Lynch coined the term 10-bagger, a stock that increases tenfold in value, and made it central to his philosophy. The goal of the individual investor is not to pick stocks that go up a little. It is to find companies so fundamentally excellent that their value multiplies many times over years. Lynch argues that these companies are more findable than most people believe, if you know what to look for. What 10-baggers look like early. The characteristics of a potential 10-bagger early in its life. It sounds boring or even slightly ridiculous. It operates in an unglamorous industry. Analysts have not discovered it yet. Institutions own very little of it. The company is growing earnings consistently, has low debt, and is expanding into new markets. Lynch found many of his greatest winners in industries like waste management, funeral homes, and auto parts, businesses that nobody at a cocktail party would brag about owning. Dull companies and dull industries with bright financials are often where the real money is made. The action for Chapter 2. Next time you hear someone dismiss a company as boring or uncool, pay attention. That reaction is sometimes the market telling you something important. Boring companies that do something essential, do it well, and grow steadily are often better investments than exciting ones. Chapter 3. The 6 Categories, Part 1. Lynch organizes all stocks into 6 categories and argues that you must know which category you own before you can make good decisions about it. The categories are slow growers, stalwarts, fast growers, cyclicals, turnarounds, and asset plays. Each behaves differently, rewards different holding periods, and carries different risks. Matching expectations to category. A slow grower, a large mature company growing slightly faster than the economy, should be owned for its dividend, not for dramatic price appreciation. A fast grower, a company expanding rapidly in a new or underserved market, should be held for years and evaluated on whether its growth story remains intact. A cyclical, a company whose fortunes rise and fall with the economy, should be bought near the bottom of its cycle and sold near the top. Confusing these categories is one of the most common and costly mistakes individual investors make. The action for Chapter 3. For each stock or fund you currently own, identify which of Lynch's 6 categories it belongs to. Then ask whether your expectations for it match the category. If you are holding a slow grower and expecting 10-bagger returns, something needs to change. Either your holding or your expectations. Chapter 4. How to Research a Company. Part 1. Lynch is a bottom-up investor. He does not start with macroeconomic predictions or market trends. He starts with individual companies and asks a simple question. Is this a good business at a reasonable price? His research process is practical and accessible. He reads the annual report, specifically the section where management discusses what went wrong last year and what they plan to do about it. Honesty in that section is a very good sign. Cheerful evasion is a red flag. The numbers that matter. Lynch focuses on a handful of key numbers. The price-to-earnings ratio compared to the company's growth rate, what he calls the PEG ratio, earnings growth over 5 years, the debt-to-equity ratio, and cash on the balance sheet. He is not interested in exotic financial modeling. He wants to understand whether a company is growing its earnings, whether it carries manageable debt, and whether the price he is paying is reasonable given that growth. Simple questions, consistently applied. The action for Chapter 4. Pick one company you interact with regularly and spend 30 minutes reading its most recent annual report. Specifically read the letter to shareholders. Ask yourself, does management seem honest about problems? Are they clear about how the business makes money? You will learn more in 30 minutes than most investors learn in a year. Chapter 5. When to buy and when to sell. Part 1. Lynch is clear that timing the market is a fool's errand. He has spent his career observing that investors lose far more money preparing for market corrections than they lose in actual corrections. The right time to buy a stock is when you have done your research, you understand the company, and the price is reasonable relative to its value. Not when the market feels safe, not when the news is positive, when the analysis supports it. When to sell. On selling, Lynch is equally direct. You sell when the story changes, not when the price drops. If you bought a company because it was growing rapidly into a new market, and that market is now saturated, or a competitor has emerged with a superior product, the story has changed. Sell. But if the price drops 20% while the underlying business continues to perform exactly as expected, the correct response is often to buy more, not to panic. Price and value are different things. This distinction, held consistently, is worth thousands of dollars to the average investor. The action for Chapter 5. For each investment you currently hold, write down in one paragraph why you own it. The story, the rationale. If you cannot write that paragraph, you do not understand the investment well enough to hold it confidently. And if the story you wrote no longer matches reality, that is your sell signal. Key takeaways. 1. The amateur investor has a genuine advantage over the professional. The lived experience of seeing great companies before analysts discover them. 2. 10 baggers, stocks that multiply tenfold, are often found in boring industries with consistent earnings growth and low institutional ownership. 3. Know the category of every stock you own: slow grower, stalwart, fast grower, cyclical, turnaround, or asset play. Match your expectations to the category. 4. Research is practical. Annual reports, earnings growth, debt levels, and a reasonable PEG ratio. Simple, consistently applied. 5. Sell when the story changes, not when the price drops. Price and value are not the same thing. A note at the end. This has been a WealthWorks summary of One Up on Wall Street by Peter Lynch. If this changed how you look at the companies around you, subscribe to WealthWorks, a new book summary every week.